Right now, in your bank account, there is a number. You think it represents money the government printed and you earned. It doesn't. Around 97 cents of every dollar in your country was never printed by anyone. It was created out of thin air by a private bank on a single keystroke the instant someone signed a loan. That is not a conspiracy theory. In 2014, the Bank of England admitted it, in writing. The money you trust with your whole life, your savings, your salary, your mortgage, is mostly just numbers typed into existence by companies that never had the cash to begin with. And the same quiet trick that built every city you have ever stood in is the exact trick that nearly burned the world economy to the ground in 2008. By the end of this video, you'll understand what money actually is, who really creates it, and why almost no one, not even the bankers, could see how fragile the whole thing was. And you will never look at your account balance the same way again. So let's start where the trick begins, in a quiet office, with a teacher, a pen, and a single click that makes hundreds of thousands of dollars appear out of nothing.
Maya sits across a desk from a man she met 20 minutes ago. She is 29 years old, a school teacher, and in front of her is a stack of paper thicker than any book she has ever read for fun. Her hand is shaking a little as she holds the pen, because the number printed near the bottom of the page is larger than every dollar she has earned in her entire life added together. $340,000. The man across the desk smiles, the way people smile when this is the 400th time they've done something that is, for you, the biggest moment of your year. He points to a line. She signs. He turns to his computer, types for a few seconds, and clicks once. And in that instant, that single quiet keystroke, $340,000 that did not exist 1 second ago, now exists. Maya doesn't know that. She thinks the bank just reached into a giant pile of other people's savings and handed a slice of it to her. She thinks somewhere, in a vault, that money was sitting and waiting, and now it's hers to borrow. That is what she was taught. That is what you were taught too. It is wrong. Remember that keystroke. We're going to come back to it. And in a quiet office in London, in the spring of 2014, a small group of economists at the most powerful bank in Britain will publish 9 pages that quietly admit the textbooks have been lying to all of us for 100 years. We'll get to those 9 pages, but not yet. First, you need to understand what just happened on that desk, because what happened to Maya happens millions of times a day, all over the world, and almost no one who signs the paper understands it, including, for a long time, the people who run the banks. Here is the thing they never tell you. This is not a story about a vault full of gold. This is not a story about your savings sitting safely somewhere, watched over by men in suits. This is not a story about money being moved from one person who has it to another person who needs it. This is a story about money being made, conjured, typed, spoken into being out of nothing at all, by private companies, on an ordinary Tuesday, for a teacher buying her first home. Money is not a thing that sits still. Money is a thing that gets created. And once you see how, once you really see it, you will never look at a bank, a loan, or the number in your own account the same way again. So let's go back, not to London in 2014, further, to a narrow street in a much older city where a man with gold in his cellar is about to discover the most powerful trick in human history.
London, the 1660s, a narrow street called Lombard Street, lined with the shops of goldsmiths. A goldsmith back then was a man with 2 things ordinary people did not have. He had gold, and he had a very, very strong safe to keep it in. So the merchants of London started bringing him their coins. "Hold this for me," they'd say. "Keep it safe." And in return, the goldsmith would write them a paper receipt, a note that said simply, "The bearer of this paper may come and collect this much gold anytime he likes." Now here is where it gets remarkable. The merchants quickly noticed something. When you wanted to pay someone, you didn't have to walk all the way to the goldsmith, collect your heavy gold, carry it across the city, and hand it over. You could just hand over the paper. The receipt itself was as good as gold, because everyone trusted that the gold behind it was real. The paper started moving from hand to hand, buying bread, buying cloth, paying debts, while the actual gold never moved at all. It just sat in the dark, in the safe, under the shop. And the goldsmith, sitting on top of all that gold, noticed something too, something that would change the world. He noticed that on any given day, only a few people ever came to collect their actual coins. Most of the gold just stayed put, week after week, year after year. So a thought crept into his mind, the kind of thought that builds empires and burns them down. What if I wrote out a few more receipts, then I have gold to back them? What if he lent paper notes, promises of gold, to a farmer who needed seed, or a merchant who needed a ship? The farmer wouldn't ask for the actual metal, he'd just spend the paper, like everyone else, and the goldsmith would charge him interest for the privilege. So he did it. He wrote receipts for gold that was not in his safe. He lent out money that did not exist. And nothing bad happened. The farmer planted his crop. The merchant bought his ship. The paper circulated, and as long as everyone believed the gold was there, it might as well have been. The goldsmith grew rich, not on the gold he owned, but on the gold he pretended to own. That right there is the entire trick. We just dress it up in nicer clothes now. The word for it is fractional reserve banking. It means a bank keeps only a small fraction of its promises backed by real hard reserves, and the rest is built on confidence. A goldsmith with 100 coins might write 300 coins worth of receipts. The other 200? Conjured, created, lent into being. Now come back to Maya and her keystroke and her $340,000. Stay with me, because this is the part that sounds impossible until you see it. When that loan officer typed and clicked, the bank didn't go find another customer's savings and shovel them into Maya's account. It didn't move existing money from point A to point B. What it did was simpler and far stranger. It typed a new number, 340,000, into Maya's account, and at the very same moment, it wrote down that Maya owed the bank 340,000. Two new entries, a deposit and a debt, created together in the same instant from nothing but a promise and a keystroke. The money in Maya's account is brand new. It did not exist that morning. The bank made it, the way the goldsmith made it. Only now, there's no gold in the cellar at all, just a number on a server, backed by your belief that it's real. Here's what most people miss. For 100 years, the textbooks told a more comfortable story. They said banks take in deposits from savers, keep a little, and lend the rest to borrowers, a polite middleman passing money from people who have it to people who need it. Calm, sensible, and almost entirely false. In 2014, a German-British economist named Richard Werner decided to actually test it, not argue about it, test it. He walked into a real bank, took out a real loan, and got permission to watch the bank's own internal books as they processed it. He wanted to see with his own eyes where the money came from. It came from nowhere. The bank didn't move funds out of some other account. It didn't draw down a reserve of existing cash. It simply created the deposit on the spot, the instant it recorded the loan. Werner had proven, with the receipts to show it, what banks had quietly been doing since Lombard Street. The loan creates the money, not the other way around. Let that land, because it's true of you too. The balance you see on your phone right now was never scooped out of a vault and set aside with your name on it. It was typed into being, the day someone signed. But here is the question that should be making you a little nervous right now. If the money in your account was created out of thin air, if the gold was never really in the cellar, then what happens on the day everyone decides, all at once, that they want their cash? Now watch what happens next. September 2007, a British bank called Northern Rock. Word gets out that it's in trouble, and something happens that Britain had not seen in roughly 150 years. A bank run. Ordinary people, teachers, retirees, parents, line up around the block, in the rain, for hours, demanding to pull out their savings, their money. The money the bank had promised was there. It wasn't there. Not most of it. It never is, because the bank had done what every bank does. It had created loans, lent the deposits into the world, kept only a thin sliver of cash on hand. The vault was mostly empty, the way it is always mostly empty. As long as we don't all show up at once, the trick holds. The moment we do, it shatters. And we have watched it shatter before, on a scale that swallowed a generation. In the Great Depression,
Between 1930 and 1933, around 9,000 American banks failed. 9,000. People stood at locked doors holding passbooks for money that had already evaporated. Savings of a lifetime, gone. Not because anyone stole the cash, but because the cash was never sitting there to begin with. It had been created, and it could uncreate just as fast. So this is the deal you've been living inside your whole life without ever signing up for it. The money is real enough to buy your house and imaginary enough to vanish in an afternoon. Hold that thought, because we're about to find out just how big this trick has become.
So let's catch our breath for 1 second, because you've already crossed the line most people never do. You now know the secret. Money isn't stored. It's created. Not by a printing press in some government basement, but by ordinary banks every time someone signs a loan. The deposit and the debt are born together, out of nothing, on a keystroke. If that one idea just rearranged something in your head, do me a small favor. Hit subscribe, because this channel exists to show you exactly how money really works, not how you were told it works. And drop a comment with the first word that came to mind when you realized the vault is empty. Now, let's see how far this goes.
So how big is this trick, really? Look at all the money in your country. Every dollar in every account, every balance on every screen. You probably assume the government printed it, the way most people do. Pay attention to this, because the real number is hard to believe. In a modern economy, only around 3% of all money is physical cash and central bank reserves, the stuff the state actually creates. The other 97%? It was created by private banks making loans. 97 cents of every dollar in your world began its life exactly the way Maya's mortgage did, as a number typed next to a debt. Economists have names for these two kinds of money. The small slice the central bank makes is called base money, the foundation. The vast ocean that commercial banks create through lending is called broad money, the money you actually live in. Your salary, your rent, your savings, your debts. Broad money, bank-made, born from loans. And once you understand that, you start to see a machine the size of the whole economy, and a loop hidden inside it. Here's the part nobody tells you. When banks create money by lending, they don't sprinkle it evenly across the world. They pour most of it into one thing: property. Banks love lending against houses because a house is collateral. If you stop paying, they take it. So the money they create floods into the housing market. And what happens to the price of anything when a flood of new money chases it? It goes up. And if you've ever stared at a listing and wondered how an ordinary house drifted so far out of reach, you are looking at the answer. It isn't only greed, or foreign buyers, or a shortage of bricks. It is the money itself multiplying with nowhere else to go. Meet Daniel, 41, owns a modest house in a city that's heating up. He bought it years ago and barely thinks about it. Then one year he notices something almost magical. His house earned more than he did. He made, say, $60,000 at his job, and his home, just by sitting there, rose $70,000 in value. He did nothing. He simply owned the asset, while the banks created more and more money that needed somewhere to go. And this is where the loop closes and starts to spin. Higher house prices mean people need bigger loans to buy in. Bigger loans mean banks create even more money. More money pushes prices higher still. Higher prices justify even bigger loans. Around and around, money creating prices, prices justifying money, a wheel that turns faster and faster. And from the inside, it doesn't feel like a wheel at all. It feels like genius. It feels like everyone is getting rich. But it gets stranger, because the banks themselves are riding the same wheel, and they are riding it on borrowed money too. Here comes a word you've heard, but maybe never felt: leverage. In finance, leverage means using borrowed money to make a bet far bigger than your own cash could make alone. Going into the year 2008, the world's biggest banks were leveraged around 30 to 1. 30 to 1. That means for every single dollar of their own real money, they had placed $30 of bets, mortgages, and bets on mortgages, and bets on the bets. When you're leveraged 30 to 1, a rise of just a few percent
makes you look like the smartest people who ever lived. And a fall of just a few percent wipes you out completely. Sit with that for a second and let it scare you a little. The entire glittering tower, Daniel's free $70,000, the rising skyline, the bonuses, the confidence, was balanced on a sliver of real capital so thin it could be erased by a small move in the wrong direction. This is not solid ground. This is not a vault of gold. This is not even the goldsmiths' careful 3-to-1. This is a hall of mirrors, money, reflecting money, stacked 30 stories high on a single floor of something real. In the strangest part of all, while the wheel is spinning up, it works, genuinely works. The new money builds real houses, hires real builders, funds real businesses, sends real kids to college. Banks creating money out of nothing is not just a flaw in the system, it is the engine of the system. It is how a poor country becomes a rich one. It is how an idea in someone's head becomes a factory with 1,000 jobs. The same trick that can vaporize 9,000 banks is also the most powerful tool for building prosperity humans have ever invented. That's what makes it so seductive and so dangerous. A fire that warms the whole house, lit in the middle of the living room floor. Before we walk into the room where that fire gets out of control, and it does, spectacularly, do one quick thing for me. If you're still with me this deep, you're exactly the kind of person this video was made for. Share it with one friend who still thinks their savings are sitting in a vault. They'll thank you, and it genuinely helps this channel reach people the textbooks left in the dark. Because now we arrive at the moment the music stops, the moment a man you've never heard of warned about, decades before it happened, the moment the wheel, the beautiful money-making wheel, begins to turn the other way.
In 1975, an economist almost no one was listening to wrote down a sentence that would haunt the next 50 years. His name was Hyman Minsky, quiet, rumpled, ignored by most of his profession, and his idea was so simple it sounded like a riddle. Stability, he said, breeds instability. Here's what he meant. When times are good for a long time, when the wheel has been spinning up, when loans keep getting paid back, when house prices only ever rise, everyone slowly forgets that things can go wrong. The banker who demands caution looks like a fool while his rival next door makes a fortune lending recklessly. So caution dies, lending gets looser, borrowers stretch further. The longer the calm lasts, the more risk everyone takes on, precisely because it feels safe. Calm doesn't prevent the storm, calm builds it. And then comes the instant Minsky's followers named after him, the Minsky moment. The point where the debt is so enormous that something, anything small goes wrong and confidence cracks. And the moment confidence cracks, the entire machine you've just watched me describe begins to run in reverse. Watch this closely, because the reversal is the whole game. Remember the loop. Banks create money. Money lifts asset prices. Rising prices justify more lending. More lending creates more money. Beautiful while it climbs, but every gear in that machine can turn backward. House prices stop rising. A few borrowers can't pay. Banks get scared and stop lending. Less new money is created. With less money chasing them, prices fall. Falling prices ruin more borrowers. Banks get more scared and lend even less. Down and down, the exact same wheel, the exact same logic, now grinding the world into powder instead of lifting it into the sky. This is the part that cheerleaders never mention. A system that creates money out of thin air on the way up can also destroy money into thin air on the way down. And because 97% of all the money is made of loans and confidence, when confidence dies, the money itself starts to disappear. That is exactly what happened on a morning in September 2008. The bets stacked 30-to-1 began to fail. House prices in America had stopped rising, then started falling, and the Hall of Mirrors began to shatter one pane at a time. And on the 15th of September, a man in a suit walked out of a glass tower in Manhattan carrying a cardboard box, and the photograph of that box ended up on the front page of every newspaper on Earth. The bank behind him had a name that was 150 years old, Lehman Brothers, and it was gone. But here's the part that should stop you cold. The danger was never really one bank. The danger was that the money is all connected.
Your deposit is someone else's loan. That loan is the collateral for another bank's bet. That bet is owed to a third bank that owes a fourth. Pull one thread, and the whole sweater starts to unravel, because there was never enough real cash underneath any of it. There never is. For a few days in the autumn of 2008, the machine that creates the world's money simply stopped. Banks were so terrified that the bank across the street might be insolvent that they refused to lend to each other at all. The flow of new money, the lifeblood of every business, every payroll, every paycheck, including yours, froze solid. Cash machines were days from going dark. Companies that had nothing to do with mortgages found they couldn't borrow to pay their workers on Friday. This is what people mean when they tell you the world economy nearly ended. It is not a figure of speech. The trick had finally, almost, run out. And who stops the bleeding when the private money machine seizes? There's one more name you need to know. Back in 1873, a writer named Walter Bagehot had described the one institution that could stand behind the whole fragile pyramid when panic hit. The central bank, acting as what he called the lender of last resort. The bank above the banks, the only one allowed to create money with no limit at all, to flood the system and stop the dying. And in 2008, that is what they did, on a scale Bagehot could never have imagined. Trillions conjured into existence to refill the vault that was always empty. They even gave the conjuring a clean, forgettable name, quantitative easing, a term coined years earlier by the same economist who later took out a loan just to prove where money really comes from, Richard Werner. So now you've seen the whole machine, the goldsmith, the keystroke, the wheel, the mirrors, the crash. And you might be thinking, surely this is a conspiracy theory. Surely the people in charge would never admit it works like this. They did. Those 9 pages, remember them? In the spring of 2014, the Bank of England, not a blogger, not a critic, but the central bank of one of the oldest financial powers on earth, published a paper in its own quarterly bulletin. It was called Money Creation in the Modern Economy, and in plain, careful language, it said the quiet part out loud. The way the textbooks describe banking, it admitted, is wrong. Banks do not lend out existing deposits. The act of lending itself creates new deposits, new money. Most of the money in the economy, the central bank confirmed in its own words, is created by commercial banks making loans. 100 years of comfortable lies corrected in 9 pages, hidden in plain sight in a document almost no one would ever read. A former head of that very bank, Mervyn King, put it even bluntly. Of all the many ways of organizing banking, he said, the worst is the one we have today. The worst from the man who ran it. And here is where it all comes home to that small desk and that shaking hand and that single keystroke. When the loan officer clicked his mouse and conjured $340,000 for Maya, he was not committing a crime. He was not breaking the rules. He was performing the exact ritual descended in an unbroken line from a goldsmith on Lombard Street that has built every city you've ever stood in and crashed every economy you've ever lived through. The same keystroke that gave Maya a home is the keystroke that multiplied 1 billion times, lifted the world, and nearly buried it. It is the most powerful force in your financial life, and almost no one can see it. You can now.
So let's bring it all home. 3 things to carry with you, and the third one matters most. The first is the plain truth. Money is not stored. It is created. The vast majority of it, around 97 cents of every dollar, is conjured into existence by private banks the instant someone signs a loan. There is no great pile of gold in a cellar. There never really was. The deposit and the debt are born together on a keystroke, and they die together when the debt is repaid. That's not a scandal. It's just the truth they never bothered to teach you. The second is what it means for you personally. In this system, debt isn't the exception. Debt is the product. New money is made by people borrowing, which means the whole machine needs you to keep borrowing, to keep running. So every time you sign a mortgage, a car loan, a credit line, understand that you are not just taking money, you are creating it and tying yourself to the wheel. That knowledge is power.
It's the difference between being used by the system and using it with your eyes open. And the third, the one I want you to feel. Everything, your home, your savings, your salary, the cash machine on the corner, the entire towering structure of modern wealth rests on a single, invisible thing. Trust, the shared belief that the numbers are real. Money is not metal, and it is not paper. It is a promise, made of confidence, written in keystrokes. It built the world you live in, and it is only ever one panic away from remembering that it was always made of nothing. But here's the quiet beauty of it. The people who get hurt the most are the ones who never understood the game, and you're not one of them anymore. So tell me, down in the comments, before you watch this, did you honestly believe your money was sitting in a vault somewhere waiting for you? Be honest. I think the answer is going to surprise a lot of people. Maya walked out of that office believing she had borrowed someone else's money. She hadn't. She had helped make it, with a single keystroke. And now, so do you. Every time you sign.
So now you can see it. The vault was always empty, the money was always made, and you'll never look at your account the same way again. But this opens a bigger question. If banks can conjure money from nothing, what happens to the money already in your pocket? I made a whole video on that, how inflation quietly steals your money. It's on your screen. Tap it. And if you want to keep pulling money apart with me, hit subscribe. I'll see you in the next one.